You don't lose your home the day you lose your job. Nothing dramatic happens at first. No alarms, no warnings. Just one missed payment, then another. And somewhere between week 3 and month 3, everything starts to fall apart. Not all at once, but slowly, and then all at once. Not in theory, not in headlines, but in real life, when the income stops and the bills don't. Let's break it down.
The moment income stops. It doesn't feel real at first. The job is gone, but your life still looks the same. You wake up in the same bed. You drink the same coffee. You check your phone, and for a moment, it almost feels like nothing changed. But something has. The money stopped. And that changes everything. At the beginning, most people don't panic because technically they're still okay. There's money in the bank, maybe a few weeks, maybe a couple months if they're lucky. So they tell themselves, I'll figure it out. I just need a little time. And that's the first illusion, because the system you're living in doesn't run on time. It runs on payments. The rent doesn't pause. The mortgage doesn't care. Insurance still bills you. Utilities still show up. Every expense you built your life around keeps moving forward, even when your income doesn't. And this is where things start to shift. Not dramatically, not all at once, but underneath the surface, pressure begins to build. Week 1 feels manageable. You cut back a little, cancel a subscription, delay a purchase. You still feel in control. Week 2, you start checking your account more often, running numbers, doing mental math. If I stretch this, maybe I can make it. By the end of the first month, the situation becomes real. Because now, you're not just unemployed, you're falling behind. And that's the moment most people don't see coming. Because losing a job isn't what breaks you. It's what happens after that does. The missed payment, the second missed payment, the late notices, the slow realization that your entire financial life was built on one thing, a paycheck that no longer exists. And from this point on, everything starts moving faster. Not your recovery, but your risk. Because now the system is watching. Lenders, landlords, credit agencies, all of them are designed to react the moment you stop paying. And this is where the path splits. Because what happens next depends on one thing. Are you renting or do you own? Because from here, the timeline changes, and the difference between weeks and months can decide everything.
When time runs out, the beginning of the end. The collapse doesn't happen in one moment. It happens in stages, and each stage feels manageable until it isn't. Week 1 still feels like a pause. You tell yourself this is temporary. You update your resume. You send a few applications. You check your email more than usual. There's still a sense of control because technically nothing is broken yet. Your bank account still has money. Your bills haven't caught up to you, and your life still looks intact. But behind the scenes, a clock has already started ticking. Week 2, the tone begins to shift, not outside, but inside your head. You start calculating everything. How long your savings will last, which bills can wait, which ones can't. You open your banking app more often than you want to admit. You start making trade-offs. Groceries get cheaper. Spending gets tighter. Things you didn't think about before suddenly matter. And this is where stress quietly enters. Not panic, just pressure. By week 3, the situation becomes harder to ignore, because now the next round of bills is coming. Rent, mortgage, insurance, utilities. And for the first time, you're not sure you can cover all of them. This is where people start making decisions that feel small but aren't. Maybe I'll just pay this one later. I'll catch up next month. That's the turning point. Because once you fall behind once, you're no longer stable. You're reacting. Month 1 ends, and this is where reality sets in.
Because now you have your first missed payment. Maybe it's rent, maybe it's your mortgage, but it's something. And that changes how the system sees you. You're no longer on track. You're now a risk. Late fees start stacking. Emails start coming in. Notifications you used to ignore now feel heavier. Month 2, this is where pressure becomes momentum. Because the bills didn't stop, they doubled. Now you don't just owe this month, you owe last month too. And catching up starts to feel impossible. This is where people dip into everything. Savings, credit cards, borrowing from friends, anything to buy more time. But time isn't free. Every delay comes with a cost. Interest, penalties, stress. And the deeper you go, the harder it is to climb back out. By month 3, you're no longer trying to stay ahead. You're trying not to collapse. And this is where the system fully reacts. Not emotionally, not personally, but mechanically. Miss enough payments and processes begin. Not warnings, actions. And this is the moment most people realize something too late. The system was never designed to wait for you to recover. It was designed to respond the moment you fall behind. And from here, everything depends on one thing: how fast that system moves. Because if you're renting, it moves fast. If you own, it moves slower. But slower doesn't mean safer. It just means you have more time to watch it happen. Renters, fast failure, low stakes. If you're renting, everything moves faster. There's no buffer, no long delay, no built-in system designed to keep you in place. You miss one payment, and the clock doesn't just tick, it accelerates. In many cases, after just one missed month, your landlord can act. Not emotionally, not personally, but contractually. Because a lease isn't flexible, it's an agreement. And once you break it, the process begins. And unlike a mortgage, there's no formal safety net, no forbearance, no restructuring, no system designed to pause your payments. You don't negotiate with a system, you negotiate with a landlord. And that changes everything. Because now your situation depends on them. If they're flexible, you might get time, maybe a week, maybe a chance to catch up. If they're not, the process moves forward. And once it starts, it's hard to stop. This is where things become real, because eviction isn't just about losing a place, it's about losing access to the next one. Once that record exists, you're no longer just a renter, you're a risk. And most landlords don't take that risk. So, even if you recover later, even if you find a new job, that one moment can follow you for years. But here's the part most people don't realize. Renters fall faster, but they also fall lighter. You don't have tens of thousands locked into a property. You don't have equity on the line. You don't lose years of savings overnight. In many cases, you lose a deposit, maybe a few penalties, and that's it. Painful, yes, but survivable. Because renters have one option that homeowners don't. They can leave before it gets worse, before the system fully closes in. They can walk away early, break the lease, disappear before eviction happens. It's not clean, it's not ideal, but it avoids something worse.
Because once eviction hits, the damage isn't just financial, it becomes permanent. And here's the uncomfortable truth. Most people don't leave early. They wait, they hope, they delay, until the system makes the decision for them. And by then, it's too late. Because renters don't fail slowly, they fail all at once. And from here, you might think homeowners have it better. More time, more protection, more control. But that's not the full story, because slower doesn't mean safer. Homeowners. Slow failure, high risk. If you own your home, things don't fall apart right away. At least, that's what it feels like. You miss a payment, and nothing happens immediately. No one shows up. No one forces you out. There's time. Weeks turn into months, and that feels like safety. But it isn't. It's delay. Because when you fall behind on a mortgage, the system doesn't rush. It waits. There are notices, warnings, deadlines, a process that can stretch 90 days, sometimes even longer. And during that time, you're given options, forbearance, loan modification, temporary relief. It sounds like help. It feels like help. But look closer and you'll see something different. Nothing is being forgiven. Everything is being delayed. The payments don't disappear. They stack. The interest doesn't stop. It grows. And while you're trying to recover, your debt is quietly increasing in the background. This is the part most people misunderstand. Homeowners don't get rescued. They get extended. More time to catch up, more time to fix things, but also more time to fall deeper. Because if your income doesn't come back, that extra time doesn't save you, it traps you. Now you don't just owe one missed payment, you owe months, plus interest, plus fees.
And catching up becomes almost impossible. But there's something else that makes this even heavier. When you own, you have more to lose. Not just your home, your savings, your down payment, your equity, years of money locked into one place. And that creates pressure. Not external pressure, internal pressure. Because walking away doesn't feel like an option. You fight harder, you stretch further, you take bigger risks just to hold on. And sometimes that makes things worse. Because instead of cutting losses, you double down on a losing situation. And if it still doesn't work, the ending is brutal. Foreclosure, a process that doesn't just take your home, it follows you for years. Your credit drops, your options shrink. Buying again? Almost impossible for a long time. Renting? Even that becomes harder. Because now, you're not just someone who fell behind, you're someone who lost everything. And here's the truth most people don't want to hear. Homeownership doesn't remove risk, it concentrates it in one asset, one payment, one fragile system dependent on your income. So yes, homeowners fall slower. They get more time, more options, more chances. But in the end, they often fall harder, because when it breaks, it doesn't just set you back, it can erase years of progress. And just when you think this is already as bad as it gets, there's another layer most people never see coming. Because losing income is only the beginning. The real problem is what happens when the systems you trusted to protect you don't.
The system that doesn't protect you. Up to this point, it feels like the problem is your income. Lose the paycheck and everything starts breaking. But that's only part of the story. Because even if you try to do everything right, there's another layer working against you. The systems that are supposed to protect you often don't. Take insurance. Most homeowners believe they're covered, that if something goes wrong, they'll be made whole again. That's the promise. But the reality is very different. because insurance isn't designed to pay easily. It's designed to pay selectively. Inside every policy, there are conditions, limitations, exclusions, and most people don't understand them until it's too late. Flood damage? Often not covered. Gradual leaks? Denied as maintenance issues. Mold? Separate problem. Wear and tear? Not their responsibility. So, when something actually happens, what people expect and what they receive are very different. Claims get delayed, paperwork gets repeated, calls go unanswered, weeks turn into months, and payouts, if they come at all, are often far below what's needed to repair the damage. So now you're not just dealing with lost income, you're dealing with unexpected costs, repairs you can't afford, damage you can't fix, and a system that keeps pushing back. This is where the pressure multiplies, because now you're forced to make impossible decisions. Drain your savings or take on more debt. Fix the house or let it deteriorate. Stay or sell at a loss.
And this isn't rare. In high-risk areas, after storms, floods, disasters, this plays out over and over again. Homes sit damaged, owners wait for help that never fully comes, and eventually, they give up, selling at a discount, walking away with far less than they expected because they can't wait anymore. And here's the deeper problem. This isn't just about insurance. It's about how risk is being shifted from institutions to individuals. You are required to have insurance, but insurance is not required to fully protect you. You are encouraged to buy, but the risks don't disappear when you do. They increase. And at the same time, the system keeps pulling more people in. Easier approvals, lower barriers, more incentives, not because it's safer, but because the system needs participation. It needs buyers. It needs borrowers. It needs you to keep it moving. But when something breaks, when income stops, when disaster hits, you're the one holding the risk, not the bank. Not the insurer, you. And this is the moment everything becomes clear. You weren't protected. You were positioned, placed inside a system that works as long as nothing goes wrong. But the moment it does, you're on your own. And that changes how you should see everything. Because now, this isn't just about homeowners versus renters anymore. It's about understanding the risk you're actually living with. And once you see that, you can't unsee it. Because there is no side without risk, only different ways of carrying it.
There is no safe side. By now, the pattern is clear. Losing a job isn't just a moment, it's a chain reaction. And once it starts, everything in your life begins to respond. Your bills, your home, your options, and most importantly, your risk. Because that's what this has always been about. Not income, not housing, risk. Renters carry it differently. They fall faster. They have less time, less protection, but they also have less to lose. They can walk away sooner, reset faster, start over even if it's painful. Homeowners carry a different weight. They get more time, more options, more chances to recover, but they also carry more exposure, more debt, more pressure, more to lose if things go wrong. And when it breaks bigger. So the question isn't which one is better, because that's the wrong question. The real question is, which risk are you willing to carry? Because there is no version of this system where risk disappears. It only shifts from renter to owner, from speed to scale, from short-term pain to long-term consequences. And most people don't realize this until they're already inside it, making decisions based on what feels safe instead of what actually is. Because stability can be an illusion. As long as the paycheck comes in, everything works. But the moment it stops, you see the system for what it really is. Not protection, pressure. And once you understand that, you start thinking differently about debt, about housing, about what security really means.
Because security isn't about what you own, it's about how long you can survive when income disappears. And that's a question most people never ask until they have to. So whether you rent or you own, make sure you understand what you're actually choosing. Because you're not choosing safety, you're choosing which risk you're willing to live with.
If you made it this far, you probably don't just watch content like this for entertainment. You're trying to understand how the system actually works. Because most people only see the surface, the job, the house, the payment, but very few see what happens underneath it. If you want more videos like this, where we break down money, housing, and the system behind it, make sure you're subscribed, comment your thinking, we will reply, and turn on notifications. Because these situations don't come with warnings. Thanks for watching, and I'll see you in the next one.